Hello, this is Brian Rezny, president of Rezny Wealth Management. We've got a great show for you again this evening. We're going to talk a lot about the economy and the investment markets. You know, we've been receiving literally dozens and dozens of phone calls, questions, emails every single week, not only for our TV but our radio show. If you have a question about your portfolio, whether it's about a stock, a bond, a mutual fund, maybe somebody unfortunately sold you a whole bunch of crummy annuities and you don't know what to do with your portfolio, go to my website, reznywealth.com, send us an email, or you can email me a question that I'll read and answer on our TV and radio show at brianrezny@reznywealth.com. Our website's at the bottom of the screen. Of course, we're taking your calls and your questions. When you call that number, talk to a studio producer, relay your question, and we'll get it answered for you this evening. One of the most important things that I want to talk about today is relative strength investing. What does that mean? It means you want to own assets that are relatively strong in an uptrend. You want to be selling assets that are starting to crest and start to become relatively weak against other competing assets. This is a strategy that Rezny Wealth Management has run for years within our client portfolio. It's extremely adaptive. I think the bottom line is this: too many investors do not have an actual investment strategy that they actually follow, which dictates when to buy, and more importantly, when do you sell assets before they're down 40, 50%. The other problem is a lot of investors falsely believe their advisor or their broker actually manages their money. Most often, this is not the case. Most advisors and brokers are really acting in a broker capacity, not in a money manager capacity. So when you ride assets down 40, 50%, and your advisor or broker tells you to hold on, things will come back, it's usually because they want to keep you in investments that they get a trailing commission on versus selling these assets before they've dropped 30, 40, 50%. If that's happened to you, chances are you don't have an investment strategy, your money's probably not being managed, and you're taking a lot more risk than you realize. Jim and Sue, Fort Myers, Florida. We attended your workshop and learned a lot. We used your fiduciary versus suitability questionnaire with our current advisor only to find out he does not work in our best interest. We are scheduled to see you next. Please explain to your listeners the difference. It's important. Jim and Sue, thanks for the nice compliments. We do have another workshop, by the way, coming up in January. There's one not only in Boca Raton, but also in Fort Myers. Go to my website, reznywealth.com. You can sign up. The workshop is entitled Adapt or Fail. What Jim and Sue are probably talking about is our fiduciary versus suitability questionnaire. Not only do we give that out free at our workshops, but you can download it for free at our website at reznywealth.com. The problem with most investors is this: one of your single biggest risks as an investor is to falsely believe all investment firms and advisors have a legal best interest to work in your best interest as a fiduciary. The sad fact is, less than about 10% of investment advisory firms are fee only and work in a fiduciary capacity. The vast majority of advisors are really brokers who work for not only brokerage houses, independent broker-dealers, insurance agents, or for the local department at the bank. Most of these advisors work under what's called suitability. Under suitability, these firms do not have a legal obligation to work in your best interest. In fact, they can downright work against your best interest. A fiduciary relationship is the most important thing you can have when you're entrusting your money not only to be managed, but with a firm that has a legal obligation to work in your best interest. Fiduciary standard of care, meaning doing what is legally in the best interest for the client, namely always putting the client's interest before the advisor. Suitability, as I made a comment earlier, which is probably about 90% of most of our TV and radio shows relationships, and unfortunately they don't understand this, usually means the advisor or firm only needs to suggest products or investments that are suitable for your objectives, income level, and age. What this means is this: under suitability, your broker does not have to have investments that are in your best interest. In fact, the broker and his or her firm can put their interests well ahead of yours. Jim and Sue, I'm glad you brought this up. We get a lot of questions about fiduciary versus suitability. Unfortunately, Wall Street, insurance agents, and banks aren't going to come out and tell you, hey, we work under suitability. You have a brokerage account. We do not have a legal obligation to work in your best interest. What you want as an investor is called a fiduciary relationship under an investment advisory agreement in an investment advisory account, which is far different than a brokerage account. Let me put it a different way. Suitability. $3 moldy loaf of bread. Your wife tells you to go to Publix to buy a loaf of bread. You can go to Publix. Let's just assume there's a moldy loaf of $3 bread sitting on the shelf for $3. In the same department at Publix, here comes the bread guy with a brand new loaf of bread for $1.50 wholesome. That would be fiduciary. So at the end of the day, you can buy an expensive moldy loaf of bread for $3, or you can basically buy a wholesome loaf of bread for $1.50 at the same store. They both look like the same loaf of bread. One's more expensive, and it's out of date, and it may have mold on it. Another one is fresh off the bread truck, $1.50. What's better for you, moldy or wholesome? Again, you make that decision. Now, I use that analogy about the moldy loaf of bread. A lot of people have been to the grocery store, and they've seen maybe from time to time, hey, here's something out of date, and it's for sale. Usually outdated stuff isn't obviously as good as fresh, wholesome, not only food items, but also investments for your portfolio. Again, go to my website at the bottom of the screen, reznywealth.com. Download for free that fiduciary versus suitability questionnaire. You'll be glad you did. Use it whether it's on your current advisor to find out if they're fee-only, fiduciary, and have a legal obligation to work in your best interest, or if you're interviewing another firm to manage your wealth. If a firm will not fill that out quickly in front of you and sign off as a fiduciary, that means you probably have a salesman, a brokerage account, and a firm who does not have a legal obligation to work in your best interest. They might be a nice person, but that's not going to do well for your portfolio, and it puts you at the back of the bus. Muhammad in Fort Myers, Florida. I want to know about the John Hancock Growth Fund Global Leaders B mutual fund, symbol USLBX. Should I buy it? Muhammad, no, absolutely not. Number one, never, ever, ever buy a mutual fund in a B or C class share. Mutual funds generally come in 4 classes. No load, meaning no commission up front, no commission on the back end. That's really what you want to buy. A shares have a front end load, and usually a 12B1 fee attached. C and B share mutual funds have back-end loads and usually have double the annual expense ratio of A shares. Never, ever, ever buy a B or C class share mutual fund, and you really should avoid A shares unless you could buy those in a no-load status. You're clearly working with a broker, so your broker is selling you a B share because it lines his pocket more than yours. The expenses on this fund are over 2%. The track record is mediocre, meaning the S&P in the last 1, 3, and 5, and 10 years has outperformed this particular mutual fund. You would be better buying something like the SPY, which is an ETF, low cost, that's outperformed this fund, or the IVV. These are all ETFs, way cheaper than this mutual fund, and have outperformed it. Now you're probably asking, why doesn't my broker show me an ETF? Because they don't make any commissions, generally speaking, or much selling an ETF. They make a whole lot more commission by selling you a mutual fund, especially C or B class shares that basically are ladled with expenses that ultimately rob your returns and take away from your net worth and your retirement. Look at ETFs. Better yet, you can call our firm for a consultation. What you really need is a fee-only money management firm with an investment strategy which includes risk management, who doesn't sell commission-based products and has a legal obligation to work in your best interest. Tony in Fort Myers, Florida. Our advisor is recommending a Pacific Life Value Select variable annuity for our 401k rollover. What do you think? Tony, never ever buy an annuity inside an IRA or any qualified account. In fact, don't ever buy an annuity, period, regardless. Annuities are sold to unsuspecting investors who don't read often the 200-page prospectus. Annuities are ladled with fees. In fact, the Value Select annuity that you talk about, and don't think Pacific Life is the only poster child of expensive variable annuities. All of these variable annuities, generally speaking, have high expenses. You would do much better off having a basket of ETFs in your portfolio. But you're clearly working with a broker under commission and under suitability. This Pacific Life variable annuity, depending what options you pick on this variable annuity, you could have an internal average annual expense ratio that comes against your return of anywhere from 3 to 5, 6, or 7%, depending what options you pick. The investment sub-accounts, limited and often mediocre. So bottom line is this. You're clearly working with a broker who's using a fancy title to deceive you. Your broker's working under suitability, meaning he has a legal obligation to himself and his firm, not to you. The variable annuity is highly expensive. It's going to rob your returns based upon the internal high cost structure of that product, and your 401k plan is already tax deferred, so sticking it into an expense-ridden account makes no sense. Your broker might be a nice person, but he's not working in your best interest. Fire that person immediately, and I would suggest you find yourself a fee-only registered investment advisory firm. Call our firm. We'd be more than happy to talk to you about managing your 401k plan rollover in your legal best interest. Maryland and Fort Myers, Florida. I've been to another retirement specialist with a local company, but I'm afraid to turn over my money to him because I fear any variable annuity. What do you think? First off, Maryland, the person selling annuity is not a retirement plan specialist. If he has that on his business card, he's giving you smoke and mirrors. He's a broker. By the way, there's over 200 designations. Most of them are bogus titles that people will sign up for, or 1 or 2 day classes to get these fancy titles, whether it's wealth management consultant, retirement specialist, whatever. These are mostly bogus titles. In fact, FINRA and the SEC has talked about this publicly, about watch out for fake and bogus titles. If the person is not a certified financial planner like myself, that means that any other title, generally speaking, could be bogus. And also, you want to go to the CFP site to make sure they're actually a certified financial planner. But the more important thing is this. The firm should be fee-only, working in a fiduciary capacity, and in a money manager capacity. What I would suggest you do, Marilyn, is go to my website right now, ReznyWealth.com. Download for free our fiduciary versus suitability questionnaire. If you would have taken that to this first person who says he's a retirement plan specialist, which again is a bogus title, he would have never filled out the questionnaire because he's not fee only, he's not in a money manager capacity, he's selling an expensive annuity. Call our office. I'm glad you're one of the intelligent people who were smart enough to call this show, ask a question, and not get suckered or sold into buying an annuity product. Lisa in Naples, Florida. I have a portfolio approximately $1.5 million. I own PIMCO Total Return Fund, PTTAX, approximately $700,000. My advisor keeps telling me to hang on to it. What do you think? First off, Lisa, I think the PIMCO Total Return Fund in the past was a good opportunity. I no longer believe that. In fact, I've been talking about the PIMCO Total Return Fund publicly for well over a year. We do not own it, and I would not buy it. The reason I would not buy it, it's too big, it's too cumbersome. The reason your broker wants to keep you in it, because he gets a trailing commission on an A share, usually a quarter a basis point a year. He wants to keep you in it. This fund actually year to date is flat to down. So what I'm going to tell you is this. This is not a fund that I would own at all. You have a fund that has an average maturity or duration around 4 to 5 years. It's less nimble because it's so big. And Bill Gross, the manager, who's done a great job in the past, is telling investors that own the fund, don't expect the same returns in the future because interest rates are at all-time lows and they're starting to move up. The problem with this fund, too big. I think the expenses are too high, and it's not nimble enough. You want to be in something like floating rate funds right now if you're looking for income. Floating rate funds move up and down along with interest rates. So this way, you get a higher increase in interest without the decrease typically in principal you're going to see on a fund like this. Again, good fund in the past, totally not appropriate today. I'm pretty much realizing that your person's a broker and wants to keep you in that fund. just to get the trailing commission, which again, your objective is to make a return on your money and to protect your principal. I don't feel that fund's going to do it, especially we're seeing rates slowly move up as we slowly see the economy getting better and better and better. You could see further losses or mediocre returns over the next 3 and 5 years with that particular fund. I'm going to take a short break. I'll be right back with your calls, your questions, and your concerns after this. Hi, I'm Brian Rezny. If you're like many investors, you've lost a lot of your retirement assets due to poor investment management or being sold investments that are often better for that so-called advisor than you. Most so-called advisors are just salespeople or brokers for investments their firms represent. No real advice at all. If you're tired of bad investment advice and are ready for positive change for your retirement, call my firm for a consultation. Don't settle for bad investment advice. There is a difference. Call us today. And we're back. We're talking a lot, of course, about the economy and the investment markets. We're taking your calls and your questions. Please visit my website. I know we're getting calls about the fiduciary versus suitability questionnaire. It is free. It is available on our website. Go to reznywealth.com. And we do have 2 upcoming workshops. They're entitled Adapt or Fail. If you're a pre-retiree or retiree and you'd like to attend one of my workshops and you're a couple, go to my website right now, reznywealth.com. At the bottom of the homepage, you'll clearly see our workshops titled Adapt or Fail. You can learn more about what we're going to talk about, and you'll learn the times and locations. We do have one in Fort Myers in January, and we do have one in Boca Raton in January also. Carl in Cape Coral, Florida. I own 450 shares of Groupon, symbol GRPN. I bought after the IPO approximately 3 years ago. It's down big. Would you keep it or sell it? Carl, great question. I would sell this quickly and take your tax loss. End of the day, Groupon is really not making any money and they're bleeding red. The stock's been relatively weak ever since it IPO'd. My rule of thumb is this with IPOs. Never, ever, ever buy an IPO, an initial public offer. And again, these are sold by brokerage firms who do investment banking. They want to get you into these things. Don't buy them. Wait 1 year. If a company comes IPO, wait a year till you get better financials on the company. You can see how it's trading, where the trend is up or down. If you would have done that with Groupon, you would have saved yourself a ton of money from loss by buying what you bought. So IPOs, don't buy them. Wait a year. Reassess the actual stock when you can get real quality research and earnings on this company. And you can also see, is the stock relatively weak going down? Don't buy it. Or is it relatively strong in an uptrend with good fundamentals? That would be a potential buy. Groupon's a sell, and I fear too many investors in the past have bought IPOs or initial public offerings because you're probably working with a brokerage house and they want to sell you and offload these IPOs. Because remember, when the company that IPO'd Groupon, they're actually working for Groupon, that brokerage house. They're not working for you. They're actually contracted with Groupon to basically raise money, take that company public, and sell it to investors like you who maybe haven't done the research and don't really understand what you're buying. Groupon's a dog. Sell it, take the tax loss, and move on. Arnold at Fort Myers, Florida. What do you think about buying gold? It's dropped a lot. Arnold, I've talked about gold all through 2013. We have not, and I want to repeat, have not owned gold. We sold our gold position back in December of 2012, towards the end of 2012. Since then, gold's down about 25, 26%. It's been relatively weak all through 2013. I firmly believe, as the economy is slowly getting better, and you're going to see the Fed starting to taper QE, gold is probably going to go down. Now, that's my opinion. We run a strict strategy off relative strength. Gold has been relatively weak all year. We sold it in December of 2012 because it fell out of our top rankings and kept getting weaker and weaker and weaker. We bought at that time IJH, which we continue to own in the portfolio because it was higher ranked than gold was. So at the end of the day, own what's relatively strong and sell what's starting to get weak. Not after it's down 25 or 30%. You want to have a mechanical system that measures the relative strength of the asset category. There's an old term called The trend is your friend. If the trend is up, that's a positive. If the trend is down, never buy into weakness. I often get comments from investors, Brian, gold's down 30% or 40%. Isn't that a buy? It could go down another 20, 30, 40%. This is true for stocks, bonds, or any investment you own. Just because it's down 20 or 30% doesn't mean it can't go down a lot more. You want to wait till that asset stops going down and starts to bottom and starts to crest up a little bit. You'll have ample time from where you sold it to where you're going to buy it. You want to miss this chunk in the middle that hurts too many investors. This is the problem with most brokerage accounts. You don't have a sell strategy because your money's actually not managed at all. Lou in Naples, Florida. I have 3 IRA accounts with Wells Fargo, approximately $150,000 each. My advisor has me in 65 stocks, 14 mutual funds, 1 variable annuity. This seems spread all over, has done poorly. What am I missing? Is he fee only? Absolutely. I'm going to answer question number 2 at the bottom. Wells Fargo, your advisor, is not fee only. In fact, Wells Fargo is a broker-dealer. None of the broker-dealers are fee only because they're a broker-dealer and they sell commission-based products. They could be fee-based, which is far different than fee only. You own a variable annuity. Variable annuities are commission-based, so that means that the person is clearly not fee only. You have a couple different accounts, $150,000 each, and they have 65 stocks in them, and you have 14 mutual funds. That is crazy. Let me pull up this slide. I call it asset allocation the failed pie. How many of you have this on your brokerage statement? Wall Street loves to sell you, and by the way, not just Wells Fargo, but all the brokerage houses do something called asset allocation. And basically it's called spread it out all over. The question is you have 65 stocks, you have 14 mutual funds. It sounds like your account values total are somewhere about $450,000, $600,000. That is crazy. You're spread all over. It's kind of like what I would say, it's like a turkey sandwich with a lot of slices of bread. Think about if you make a turkey sandwich and you put a slice of bread down. You put the turkey on and another slice of bread. You've got a turkey sandwich. You can taste the turkey. Asset allocation, or what your portfolio sounds like it resembles, is a slice of bread and about 10 more slices of bread, little turkey, and a lot more slices of bread. Does that make any sense to you when you're making a turkey sandwich? If it doesn't, then your portfolio makes 0 sense either. You're probably doing poorly because you're spread all over. You have weak assets which are dragging strong assets down, so that means you're not making any money. I would love to have you come into our office. I'd love to see the stocks you own and the mutual funds and the annuity, which is clearly under suitability. I don't know if your other accounts are fee-based or commission-based, but you're clearly over-diversified, in my opinion. You probably have a whole bunch of overlap of the same kinds of investments. The 65 stocks you own are probably the same stocks that are actually in a lot of the mutual funds. So you own some of the same things maybe over and over and over again. Again, call our office for a consultation, Lou. I would love to sit down with you at our Naples or Fort Myers office. Our number's at the bottom of the screen, and you can also visit our website, ReznyWealth.com. You can sign up for our workshop, our Adapt or Fail workshop, which would give you a whole bunch of education, why asset allocation is a failed investment strategy, and in my opinion, no strategy at all. You can also get more information about our firm. You can download our reports, how to avoid outliving your money during retirement, and our fiduciary versus suitability questionnaire. I would suggest you download that, bring that to your advisor, and see if he or she is willing to fill it out and act in a 100% fee-only fiduciary capacity in a money manager role. Larry in Fort Myers, Florida, our advisor is recommending a variable annuity and a non-publicly traded REIT for our 401k plan. I am Larry after listening to your show. What do you think, and will your firm handle an account of $650,000? Oh, Larry, first off, and we had a call about this earlier, never, ever, ever put your IRA, your Roth, or a rollover of any kind of qualified plan into a variable annuity. That makes 0 sense at all. Variable annuities are sold by brokers who want to line their pockets more than you. That is simple. The broker is working clearly under suitability because they're selling you variable annuities for commission and non-publicly traded REITs for commission. Suitability means your interests are put at the back of the line. Unfortunately, most investors falsely believe that Mr. Nice Guy that you sit down with is working in your best interest. I would stress you go to my website, download for free that fiduciary versus suitability questionnaire. Also, never ever buy any complex products. This is going to answer more of your question. Complex products don't belong in your portfolio. Plain and simple. These are the products. If these are in your brokerage account, these are products, in my opinion, that are toxic, expensive, and don't belong. Avoid these investments. Variable annuities, mutual funds, A, B, and C share, structured products, non-publicly traded REITs, fixed equity index annuities, or hybrid annuities as they're called now, and managed futures. Those are the ones on my hit list. There's others, but those are the ones that brokerage firms, investment departments at the local bank, and insurance agents love to sell. Again, complex products are riddled with fees. They often are hard to get out of or have big back-end penalties. Avoid these. People that sell these products are working, again, under suitability. They do not have a legal obligation to work in your best interest. The last caller question is spot on. These are, unfortunately, the kinds of bad advice we see all the time. We get these calls on my TV and radio show. The person who has sold 4 or 5 annuities or sold a whole bunch of mutual funds for commission, the money's never really managed because you're not in an advisory account, you're in a brokerage account. And falsely people believing that all firms have a legal obligation to work in your best interest, that's a major crux of the problem. If you really sit down, if you go through that fiduciary versus suitability questionnaire, it's 13 questions. It'll teach you what you were never taught before, or better yet, it'll teach you what the brokerage firm didn't want you to know. I really appreciate all the calls and questions. I want to make sure that you all visit our website, ReznyWealth.com. You can also send me an email question at brianrezny@ReznyWealth.com, and I'll answer that on the next TV or radio show. We do have a live show, of course, every Sunday throughout Florida from 10 to noon. You can visit my website, ReznyWealth.com, sign up for a consultation with my firm. We do have offices in Naples and Fort Myers, and you can also sign up to attend one of our upcoming workshops, Adapt or Fail. Perfect for your pre-retirees and retirees. Remember, bad investment advice doesn't fix itself. There is a difference. Call us for a consultation. We would love to help you rebuild your portfolio. Have a great day.